Investments, Carlo, will be sharing some practical perspectives on how to navigate volatility and identify opportunity in today's crypto markets. Before we begin, just a few bits of housekeeping. So this session is intended for AMINA's clients and prospects in Switzerland and our clients in the GCC region. The content today is shared for educational purposes and should not be considered as financial advice. To maintain AMINA's standards of client confidentiality, all participants are joining anonymously. From the chat and the live Q&A have been disabled. However, you are welcome to submit anonymously any questions using the link that you will find in the email. As I mentioned, the session will be recorded and we'll share that by email later. And with that, I'm really pleased to hand over to Andrea, our head of derivatives trading.
Good afternoon, everyone, and welcome to our webinar, to the first in the series of webinars that we're planning, and we're very excited to welcome you. In order to use the time in the best way, I'll just jump into it. So I will present today a little bit of the macro context of the markets. We want to give you a picture. Of course, just one perspective, right? This is my perspective, or the trading perspective, our perspective on what's happening in the global markets, in very short snippets and pictures, and then place the crypto with a little bit more detail. Crypto spot, specifically Bitcoin and Ethereum, the majors, also some other coins, volatility picture. And also, how do we use the quantitative models that we've built internally to navigate the markets, to assess the situation, and the models that we use on the trading desk, and that also investment solutions use in their day-to-day management. And there, I'll pass it on to Carlo to talk about investment solutions and strategies, and further gems that he has prepared. So please, Tally, if we can go to the next slide. Really big picture and long-term big picture. Equities and government bond yields are trading higher. We have here two equity markets, Dow Jones and NASDAQ. Dow Jones is the industrial US index that captures a lot of international interest also. And NASDAQ is obviously tech, AI also related, closer to crypto, and is more played by US retail. Both of these markets over the last 5 to 6 years are trending from bottom left to top right, consistent inflows and consistent price appreciation. At the same time, we're using here the Japanese 10-year yield as the benchmark, where we also see the yield going from bottom left to top right, from 50 basis points area towards north of 2%, where it is now. And other government bond markets are behaving in a similar way, albeit a little bit less pronounced. So we're just using that here, and so what we're illustrating here is that there is a kind of a rotation out of the government assets into the private assets. That's an overarching theme that is most likely to continue for the years ahead. This is also a theme which is crypto supportive in the end, over the medium and long term. And it's very important to remember that as this rotation happens, the markets that are most that can benefit the most from this rotation are the US markets, because they're the deepest and the most liquid. So in case that the bonds start selling off a little bit faster than normal, then that money is most likely to move, or that capital is most likely to move into the US equity markets and less in other less liquid markets. So next slide, please, Tally. The other thing, which is the other theme, which is very pronounced and is kind of more and more in our minds and in front of our eyes every day are the escalating geopolitical tensions. I don't need to spend too much time on this, and I'm not an expert, but we have a Middle Eastern crisis between Iran and Israel, US deeply involved there. We have now a 4-year special military operation or a war happening between Russia and Ukraine, where the Western powers are involved from a distance, and NATO is on the brink of being involved. We've had a US special operation in Venezuela. This is escalating towards Cuba in the headlines every day. We have also disputes around Greenland between Denmark and US and the greater European Union. So this is even just in the Western Front between EU and US. These are very complicated situations, all of them. And they are talking about a complex geopolitical situation in the world, which is also, there has to be some sort of rebalancing of power when things like this are happening. How far it goes, how complicated it gets, and how many real physical conflicts we have, military conflicts we'll see. But this is an ongoing situation, and certainly it's threatening to bring in capital controls. Now, both of these themes as of late, the one that's the most in the headlines right now are Iran and US. And we have seen different impacts coming from developments in the Middle East. Even one last night where there was another escalation, and basically we've seen oil prices shoot up. So this is something to definitely keep watching. On the equity side, while the prevailing theme has been higher prices, in the recent in 2026, since we had a sell-off in the global assets, we've had a deleveraging that we've seen in the past weeks. Equities have held up well, but underneath we have seen a lot of dispersion in the equity indices, which is also talking about potential risk to equity prices going forward. So next slide, please, Tali. So what's happening with cryptocurrencies in this environment? There are three pictures here, and we'll show them in more detail. But Bitcoin sold off very heavily in 2026 and bottomed out on the 6th of February at 60,000. We see this as the first support, 58 to 60K. And technical resistance, first one, 73, 75,000. Going on towards 80,000. And we're looking, of course, at Bitcoin as the bellwether for the whole crypto asset class. And then we want to look at some longer-term charts that talk about cyclicality of Bitcoin and also where we are in that cycle. So the first thing to note is that the Bitcoin has been trading within a 4-year cycle since its inception. And there are some doubts about that 4-year cycle now that there is a higher institutional adoption in play. Regardless of that institutional adoption, so far the 4-year cycle has played out perfectly. So let's please show the next slide for a moment, Ali. And here you can see basically on the bottom is just like a sinus function, a cyclical oscillator, which is capturing the cycles in Bitcoin. And according to that model, Bitcoin should have had a high exactly when we had the high so far. And so the performance of Bitcoin in 2025 and into 2026 has been perfectly according to the Bitcoin usual cycle. According also to that cyclical picture, Bitcoin is most likely to bottom out in the late 2026, so Q3, Q4 2026. Now let's also show the next chart, please, Tali. Here we have it's called the banana chart, or the kind of log scale chart of Bitcoin over long term, showing a consistent buying and selling zones. And we can see here that Bitcoin in the last cycle has not really reached its selling zone, which I think took many by surprise, but that's maybe a consequence of a maturing market, but has now reached the top end of the buying zone. However, that buying zone is currently between 39,000 and 64,000 in the long run. So if we now put these two charts together and say, okay, normally in a cyclical, watching the Bitcoin's cyclical pattern, we can expect that the low to come in late 2026. Then according to these bands here, we can expect that low to be somewhere between probably 35 and 60,000, right? Based on the previous cycles. And please go back 2 slides now, Tally, to the original slide. Yeah, here. So cyclically, that's why 35 to 50,000 we say is the long-term support. However, perhaps things have changed and this could be the bottom. Now, in the top right corner, we have the map of Bitcoin drawdowns since 2011. So we can also see that this latest drawdown, again, compared to the past, still has some room to go. So where are we now? We are consolidating. And we like this term, the crypto market is healing after an aggressive sell-off. Is this the low? Possibly could be, but according to the 4-year cycle, probably there could be some more downside later in the year. We also think that of the macro factors, the dollar could really play a big role here. The dollar has generally been sold recently, but there's a big short position in the markets, and it's quite disliked. But if something changes in the macro picture and the dollar turns very strong, this is usually a strong headwind for crypto. So while the initial picture of assets moving from public to private and is supportive for crypto, the short term is not so supportive, and it's mainly due to the cyclicality of Bitcoin rather than anything else. We just see, we think that cyclicality is the cause, and then these other things are the catalysts. Let's now please move past these slides, Tally. So yeah, and next one. So let's look at also some other things that have been talked about. Bitcoin versus dollar yen. This last sell-off in Bitcoin, Bitcoin is the candle chart and dollar yen is the blue chart on top of Bitcoin here, just to show something. So there's clearly some correlation between dollar yen and Bitcoin. And dollar yen is a kind of a liquidity proxy because yen is being used for financing carry trades across the globe. However, in some crypto circles recently, yen has been blamed for the sell-off in Bitcoin. And if we look at this chart, that doesn't really explain what's going on here, because it looks like Bitcoin started selling off a lot sooner than dollar yen came off. And the movement in dollar yen is just a little blip, while the sell-off, this last sell-off in Bitcoin, which is correlated, has been from 85,000 to 60. So that's a 30, close to a 30% drop, while dollar yen only sold off about a couple of percent. So is there a correlation? Yes, but could have dollar yen been a trigger for further liquidations? Yes, but you can't explain such a big move by dollar yen. So next slide, please, Tally. Here we see an asset which is a lot more correlated to Bitcoin. Left side is the longer term chart, right side is the short term chart. Again, Bitcoin is the candle chart, the red and green. And the blue line in front is IGV. This is an ETF which tracks software as a service companies in US. So here we can see that IGV started rallying a bit before Bitcoin in the last cycle. They've tracked each other very well. Maybe Bitcoin started selling off from the highs sooner, but this last leg down was led by IGV, and they have bottomed out at the same day. And so far, they're both trading sideways. This is interesting because this is connected to Bitcoin being more of an institutional asset these days, heavily traded in US. And we can maybe say that the US traders trade Bitcoin as a software company. we cannot draw any more conclusions about this so far, but we're just drawing a parallel here that we thought was interesting. So next slide, please, Dali. And finally, to wrap up the overall crypto picture, let's look at the fear and greed index for crypto. It's at 9 today. It hit lows of 5. This is extreme fear. And this index has been around for a long time. You can see below the index itself, its long-term historical chart. It goes goes back very far. If you're interested, you can get this on internet yourself. Just type in crypto fear and greed index. But what's on that long-term chart of the fear and greed index, you can see how low we are. I kind of circled with red just in the bottom red corner of that chart. It's very extreme. We have only seen these levels in 2019 and 2022, and similar levels in some intermediate sell-offs, but these are very significant market bottoms. So sentiment in crypto is very, very negative. Now to recap the crypto story, we know that crypto adjusts first because it's it has maybe less, I don't want to say less manipulation, but it's a maybe more honest market where people adjust positions very quickly. Okay, so crypto adjusts first and is currently in a consolidating and a healing phase. Looking at the sentiment and looking at what happened recently, bounce is certainly on the cards. It can happen anytime. It could be very sharp. However, the macro picture right now, because of a potential stronger dollar, because of ongoing geopolitical risks, and because of the recent underperformance of crypto in a market where there's in 2026, there are a lot of losses across strategies. So investors are unlikely to take on new risk. This is all acting as a headwind to crypto. I'll mention quickly MicroStrategy that probably everyone knows about, but this is another sentiment negative factor at the moment. It was a positive in the bull run, but in this phase, the market is worried about potential supply coming out of MicroStrategy. Our research did a good piece on this. It's unlikely that we see anything until 2028 because of the debt maturities, but there is a real risk that market somehow tests Michael Saylor, and it's not helping right now that his strategy is underwater. Also, equities could cause the next leg lower because we haven't seen equities come off, and we have seen that there are correlations. So this is something that is also an impediment for a cyclical bounce in crypto. A potential catalyst that we are witnessing right now is the escalation in the tensions between Iran and US. The high risk of a pullback in equities is in the coming weeks, in the March and April period. And overnight price action with FOMC basically discussing hikes at the same time as cuts has shown that that this is a live and ongoing topic. We mentioned this cyclical low expected Q3, Q4 2026. And crypto investors overall are well prepared to handle this downturn, most of them, and are looking, as usual, knowing these cycles, they're looking for entry levels for the 2028 bull cycle that should come on the heels of what's going on right now. So this kind of finalizes the overview of the macro factors and crypto in it. And well, one more slide. Thank you, Tali. Actually, here, just to quickly look at what happened in the volatility. Now, I'm not sure how technical everyone here is, but I'll try to make it very simple here. So on the left, we have Bitcoin and Ethereum at the money term structure. These are the slides on the left, the top and the bottom. So they show where the volatility is priced, and the bold line, the full line, is the current implied volatility curve. The dotted lines represent where volatility was before the sell-off on 28th of February, local high. Bitcoin was 85K then. That is, on this graph, that's the bottom dotted line. And the top dotted line is where volatility was at the peak of the negative sentiment and the lowest prices on the 6th of February. So you can see that now the full line has almost fully retraced back in the very front end in the 1-day expiry. It's the same where it was before the sell-off. And in the back, there is still some premium, but it is mostly normalized. Now, it has not normalized. It has not normalized equivalently. So you can see in the middle that there is still some premium for the middle and the back end of the curve. And so we see some opportunities here to sell volatility. I will leave it at that for this slide, but this is something that we can cover more in other situations. So now I want to tell you a little bit about the tools that we are using to map the market, to look at it, to assess it, and to come up with the right strategies and the right ways to protect the portfolio or to rebalance it. This is our market regime model, which is a momentum model created to tell us what is the trend. Okay, and so on the top is Bitcoin, bottom left is Solana, bottom right is Ethereum. We map it into green when the market is bullish, into red when the market is bearish, and yellow when we find that it's sideways. So what's interesting here is that you can see on Bitcoin, the red phase, we picked it up late last year while Bitcoin was still around 110K. And then you can see also that the really red phase doesn't come very often. We didn't have one since 2022. So this gave us a very good sense that we are already in not a short-term in a short-term profit taking, but more that we're moving towards a cyclical bear phase. And this model helped us adjust our strategy. You can see also that Solana is in a very strong bearish cycle, and that Ethereum is a kind of a more sideways, right? Because it's moving between kind of 2K and 4K already for a few years. So very aggressive moves, but more sideways rather than bullish and bearish. So next slide, please, Dali. Here is a little more detail on the Bitcoin model, and it's the same. The chart on the left is the same market regime for Bitcoin, but on the right, we have backtested how does actually not just using this as a color chart, but how would the trading strategy work that would go long the Bitcoin when the trend is bullish and short the Bitcoin when the trend is bearish. And so the light blue on the right presents the P&L of that strategy through time, and the dark blue presents the P&L of Bitcoin. So we're showing here that actually this model outperforms Bitcoin quite significantly by about 2.5 to 1 over the past 6 years. So that's why we also like this model can be used for trading directly on it, but we use it as an input into our decisions and into our market view. Where are we now? We look, are we in a bullish or a bearish trend? And this model was quite helpful to see the bearish trend already back end of last year. Next slide, please, Dali. Then another thing that we do, we look at the derivatives market. And so the spot market gives us the trend, but the derivative market gives us an indication of the sentiment and positioning. Because we have derivatives or options for different expiries, we can judge how the sentiment is for 1 week or 1 month or 3 months, 6 months, and we can compare these things and come up with different types of ideas or portfolio adjustments. And so that part that is derivatives based, we feed into a machine learning model, and we use all the existing data over the past 5+ years to basically assess the probability of a larger move up or down in the coming period. Next slide, please. So here on this slide, we're explaining a little bit how this derivatives, the decisioning, all the inputs that go into the machine learning model. There's many more, but we have a few here. So futures basis, skew, implied vol, realized vol, statistical levels for all of these. But we're feeding all of this stuff into the machine learning model on a daily basis, and we are letting it give us an idea of what might happen in the market in the coming weeks. Next slide, please, Dali. So these two models together, this is now only 1 year of Bitcoin price history, also mapped in the market regime model that we talked about. That's in the front, that's the line, but in the back is what the machine learning model is saying about the next potential move, so forward-looking part of the model. And you can see here, this is a not perfect model, but it was mainly flashing green in the early 2025, and in the late 2025, it started flashing red. You can also see that sometimes it's black, so sometimes it cannot tell if it's up or down. So it cannot be taken at face value, but it backtests quite well, and we use this actually. So Carlo and his team, and he will talk about that more later, they use this to apply a discretionary overlay. As one example here, also towards the end of 2026, or towards the latest date, you can see that there was like a green vertical line. So at some point it was getting a little bit bullish, but you have to take that in the context of the overall bearishness. And then we also look at what the spot is telling us, which is still bearish, right? So you discount that signal a little bit, or there is a discretionary decision on top of this. Okay, I've lost the slides. Dali, can we go to the next slide, please?
Yeah, bear with me 1 second, Andrea. We're having a bit of a problem with the slides. They're not progressing correctly. So I'm just going to go to the next slide for you, and then you can continue from there. So just give me 1 second. So we're on slide 17.
Yeah, and maybe you can you maximize the screen, because right now we can also see, yeah, that's it.
There we go. Sorry about that.
So, yeah, no problem, Dali. Thank you very much. So you've seen how it looks on one specific strategy a second ago. That model was for one specific strategy, and we're monitoring many strategies at the same time. We get many signals, and then we interpret what that means, right? So, for example, late January, the signals were saying to harness yield via call overwriting. That means, you hold the coins and you sell call options, and the models are saying it's safe to do that right now. So we don't do it blindly, or we don't look at that trade blindly. We look at the models to tell us, is that a good trade or not? And so they were saying overwrite. So the upside is capped. But then on the Wednesday of the 28th of Jan, the hedging signals basically good. It's a good time to hedge. We started seeing, and this was right before the drop. On Friday, February 6th, things started changing, and it stopped recommending call overriding. And actually, there was that one little green line. It started saying buy calls for a few days. So the best way that we could interpret that was not to get very bullish suddenly. We would also look, so the trend is still bearish, but maybe there is more potential to either consolidate, or maybe there will be a bounce right now. So kind of the sell-off is tired right here, right now. Last time or on February 10th, the model moved back to a more cautious stance. And so this is something that this is a kind of data analysis that we use on a day-to-day basis on the trading side, and also in the investment solutions team, and Carlo will talk about that more. Yeah, and so to recap, we're collecting the data, we are sorting it and combining it, right, from different parts of the market, from the spot market, from the volatility market, from some parameters which are mixed. We use machine learning to be able to process a lot more data at the same time, and we tweak and fine-tune those models. And we look at the historical performance to really say, can we trust the models or not, and how best to combine them. So this is something that we think is a very, very good way to navigate current markets that are very volatile, and that have many external factors that are very unpredictable right now. And with that, I'll finish my presentation and pass on to Carlo.
Good stuff. Thank you very much, Andrea. Can you all hear me? Thumbs up. Good. Okay. In the interest of time, if you wouldn't mind going to the next slide, please, Telly. I'm going to move through these initial slides quite quicker and get to the meat of the story. But essentially, AMINA Bank is a specialist bank, recognizing that our clients have very specialist needs. If we just look at the 30,000 picture level, we offer custody, we have trading from spots, derivatives, the loans, the staking securities. We also have a very strong quantitative framework in terms of, how, as you've seen from Andrea's slides, and how we perceive risk in the market. We have a strong research team. And then my business is the investment solutions, where we run mandates, we look at portfolio strategy construction, we have structured products, we have the ETPs, and we have bespoke or tailored solutions, hedge funds, external third-party products, and other solutions. And of course, we have the relationship management team with the personalized touch that brings the whole overlay together. Let's go forward, if you don't mind. If we have, again, another look or perspective of AMINA Bank from a treasury or wealth management perspective for combined portfolios, either if you're in TradFi or if you're in crypto, and it doesn't matter whether you're an ultra high net worth individual or a corporate or an institution, AMINA Bank really has it all. If you are, we seamlessly transfer assets from the TradFi space into crypto and vice versa. If we look at the one angle of attack, you can see that if you're in the fiat world and that's your starting position, you can access crypto via AMINA Bank through our own product suite, whether it be a long short volatility strategy that Andrea developed, third-party funds and products, the TradFi, or basically fiat, there's hedging techniques and strategies, all stables. And the little blocks in the middle really show the level of sophistication from, you can access crypto from the fiat world, either through just dollar cost averaging, using those signals that Andrea showed in terms of trying to time the market in a more intelligent way. Of course, it's not 100% guaranteed, but at least it gives you some sort of trend following momentum indicator where you are in the cycle. We have other products like selling options, which is put options, where clients will sell puts that are cash collateralized. They can accumulate coins at a cheaper level if their options are exercised, at the same time benefiting from a yield upfront. If we go again right to the other end of the spectrum, we have more sophisticated products. Go back to the other slide. The last sophisticated products example is an accumulator where you use a structured product to accrue coins at a discount potentially to spot. Now, if we go to the next slide, we come from the other angle of attack. If you're in the crypto, if you're a crypto native and you're long crypto coins, you can now roll off into the traditional finance market again through similar products. I'm not going to go through every single one, but they basically are the reverse, and Andrea touched on them. Selling calls at certain strike prices to receive a yield, but then if you exercise, you exit at that price that you predetermined, which is a win. They have products like decumulators where you do the reverse of the accumulator. You can de-exposure yourself in crypto, and then obviously selling spot through well-timed market signals that we provide. And we all have and then we have all the products and services as well at the very bottom. If we can go to the next slide, Teddy. And then here we go. Here's the combined picture. So that's the whole wealth management, treasury management map overlaid with this quantitative approach that Andrea mentioned. Let's go forward. Let's stay here for a second. So, go back one. So framing the current environment, as part of the investment solutions team, our role really is to step back and take a medium to longer term view, especially when markets get noisy like they are at the moment. Of course, over the last few weeks, Bitcoin has clearly shifted into a bear phase, as pointed out by our signals and sentiment in the market and price action. But that doesn't really translate into straight line declines. It could be locksteps down. And of course, bear markets can include sharp rallies, fast rebounds. All of this is normal. What really changes is how we interpret these moves. In this type of environment, if we react to every short-term move and every short-term swing, it's usually where mistakes are made. There are oversold signals, quick bounces, sudden sell-offs, and it feels, and managing portfolios, it feels very important in the moment, but often it's just part of this process. So rather than us trading at every fluctuation, we zoom out, we focus on regime, positioning, and risk. And that wider perspective gives us guidance on how we structure and manage these quant-driven derivative mandates. I'm not going to talk to what Andreas mentioned about, no clear upside catalyst at the moment, but all these recent full pullbacks really still feel consistent with this cyclical downturn rather than just a brief correction. Macro conditions remain heavy. Leverage is still being reduced in the crypto market, so sentiment is fragile. And of course, with the broad AI tech risk on, then risk off dynamics, it continues to have this weight on the crypto market, as Andrea mentioned with that ETF. He talked about moving into the summer months when liquidity dries up and softens, and that can amplify these moves, making it feel more directional rather than the underlying fundamentals may suggest. So we respect the cyclical downturning and the framing of it, but as this looks, it seems like a broad deleveraging reset and not particularly a complete collapse. And of course, near-term volatility persists, but structurally, it looks like a market that's clearing excess rather than falling apart. So when we onboard new mandates requiring spot allocation, we use these trend change signals to guide timing. We operate a multi-strategy framework going from yield generating and hedging, all guided by the quant inputs and, of course, our discretion. So the goal is consistent liquidity generation or protecting while managing convex risk to the upside. Now we can turn. I'm going to go through this one quicker. If we just look at a very simple use case, most of our clients are crypto natives, they're hodlers, they've accrued coins over a long period of time. Their goal is to accumulate Bitcoin, sweat their asset, use it as collateral. They obviously want to reduce risk, protect their stack, and they come to AMINA because we have this institutional grade setup. One of the use cases they can sell out the money call options, like Andrea mentioned, and benefit from this quantitative framework to identify risk and very risky trades and not trade when conditions are perceived to be unfavorable. We target yields on Bitcoin, for instance, between 8 and 12%. Recently, we did a trade at 27% while managing the risk. And all of this the goal is to outperform and buy more Bitcoin using the machine learning model, the quant framework, and our discretion. Let's go. Next slide. So if we transition to the quant framework, let's put it this way. Before I talk current positioning of our mandates, let me walk you through the quant structure. We run the quant framework. Again, it guides us to when to hedge, when to generate liquidity, and when to step away from perceived risk. Andrea really talked to this originally, but just a quick recap. This is a spot regime and trend change indicator for a 2-week covered call strategy. So you can see the line is the price of Bitcoin mapped to where we are in the cycle. And in the background is the environment for the next 2 weeks. And for quite some time, it's been sideways. We could flip the slide. Thanks, Tally. So how do we practically apply this? So if you had to systematically, blindly, automatically, without any intelligence, just routinely do this every 2 weeks, sell a call option, receive the premium, buy more Bitcoin, what would the picture look like? It would look horrendous. You can see that the green line is the core overriding strategy, significantly underperformed Bitcoin. If you add the trend change market regime indicators and the trend change indicators, if we flip to the next slide, Tally, you can see that the strategy flips. So by merely using intelligence of where there could be perceived risk or change or trend to the upside for the next 2 weeks, you simply pause the strategy, you step out until the signal or the quant models flashes green, and you apply discretion in terms of your spot to strike ratio, how much yield you'll generate for that particular trade. The strategy strips from a return perspective as well as from a risk perspective. You can see the max drawdowns are the same, but from a Sharpe ratio, it's much more improved. And the analyzed return, the alpha there is roughly 18% annualized. Now, this is back tested through the machine learning model, but we've also have a number of live mandates that have been using this quant framework since August, September last year. So what's important is not just return, but also accumulating coins and risk avoidance in this slide, all wrapped into one. If we flip to the next slide, please. This is my favorite graph because it just shows how effective was this trade. So again, the blue line is obvious, it's a Bitcoin price. The little dots in black are when you open a 2-week covered call trade, the previous slide. Sometimes the cross is when you close it, and the square is when you close a trade and roll it into a new one, because the trading signal of the quant model said, yes, there's no perceived risk to the upside. The immediate thing you should see is that when you use the quant-driven framework, there's the winning trades are all the green stars. The losing trades, or when spot is above the short call strike, are the red stars, which are very few. So there's way more green winning trades than there are red losing trades. The propensity, the distance of the line, shows you how much out the money did the trade expire versus that short call strike. So it's a very long line. Then this thing was really low risk and expired out the money. The premium was realized, and off you go into a potentially new trade if the quant signal said, yes, there's a very low risk of change or trend to the upside. You can also see just before 2021, when you had that massive bull market, the model did not trade. So it has this reluctancy to not trade because the empirical price action of Bitcoin through its 4-year halving cycle is to increase in price. So it timed the market very, very well in 2021 in that very strong bull run. It did not have a short call strike. Otherwise, you would have been completely taken out. So this is the approach that we use in our live mandates, and some of our clients on an execution-only basis ask us for signals, what the signals are flashing, but it gives us, the guidance we need in terms of perceiving risk in the market going forward. We can go to the next one. The flip side, of course, some clients want to be defensive in nature and want to protect their stack and not require any yield. They have no liquidity requirement. So we propose doing a zero-cost hedge. Really, it is a 30-day trade in this example where you buy put option. It protects you from any downward movement at 95% of the spot price. That's why it says 95 at the top. So you buy a put option at 95. How do you pay for it? You either use cash, but the other way of doing it is to sell a call option at the same price of buying the put. So you have a zero cost structure. You're funding your long put option by selling a short call option. And it's basically an overlay. If you've got Bitcoin doing this, you have a put at the bottom to protect you. You have a short call that pays for the put above it. And you hope that the price will stay in between or crash so that you're protected. Again, if you do this every 30 days blindly in very strong bull markets, you would have been capped out. Your max return would have been capped at that short call strike. No good. If you apply the intelligence of the model to guide you when it's perceived risk to the upside and to the downside, i.e. it could be a good idea to have a hedge on and protect yourself. If we flip the slide, lo and behold, the strategy works again because you are managing the change of trend to the upside. So you can see the drawdown is significantly reduced from 76 to 56, which is significant. And you just need to catch one or two of these very big corrective periods where that put option is exercised and you protect it and it puts you back up. And you can see all the, from the risk reward perspective, significantly improved. Let's go to the next slide, Tally. Again, to summarize it, this looks complex, but it actually is quite simple. It shows you again when you would put the hedge on, put the protection on by selling the call. The green stars are the long put options where you would have been protected. The red stars are where the short calls are, and the blue line is Bitcoin. And just to focus on one example, if you look at 2024 June, right in the middle, you can see that the blue line, where the black dot is far below the green star. The green star is where you bought a put option by selling the call. And you can see that the call was sold at $46,000 at that time. The put was bought at $42,000, and spot was basically half at 20,000. So you made the profit between 42K and 20K is locked in, bought more Bitcoin, and off you go. So it's the reinvestment, accumulation, and let's call it protecting your Bitcoin stack. And you can see very infrequently did the model trade because it caught the upward trends, and it also caught the downward trend so that that long put option would end in the money. Should we go to the next slide? Okay, not yet. We can go back one slide. Let me quickly wrap up. I'll get into 3 minutes.
No problem. Keep going.
So how are we positioning ourselves in mandates? From a positioning perspective, we remain cautious on doing low delta short call selling or smart cost-effective hedging strategies because it is expensive to hedge and buy protection at the moment. When our research and discretion backed by our quant signals indicate a bear regime like it has of late, and there's no confirmed upside trend for the next 14 to 30 days, we position accordingly. So if the market is expected to move sideways or drift lower, we have two primary approaches. I think the first one is to do low delta covered calls to collect the premium, particularly in the sideways dripping market, or gradually weakening market. As Andrea mentioned, a slightly unhealthy, bruised, healing market. And then we do zero cost collars or these put spread collars to buy downside protection that's funded by the short calls, like I mentioned. We've also bought outright long put options, crash protection. We run, as I mentioned earlier, multiple quant-driven base mandates where this is the one core input. I'll give an example. For instance, in the recent sell-off, we were very active, not passive at all, which is typically the tendency to be in very uncertain times. But it turned out that most of our decision-making activities paid off. On the derivative side, we timed key moves really well. We unwound two very deep in the money put options, hedges that were in favor for us. They were struck at $82,000 and we unwound them at $68.69. So we monetized roughly $13,000 per Bitcoin per contract, which is a good outcome. And we took those gains and we rolled the hedge forward and bought crash protection at 60K. This is for one of our mandates. What we also realized is when you want protection, it's very expensive at that time. Put skew has been very real. And in other words, most traders have been positioning by either buying put options or selling put options, but the volatility for put options is higher than call options. So it hasn't made hedging very, well priced or attractive, but we've implemented spreads, buy a put option and then sell a put option, just protect yourself in a range. But the minute this flips where, skew is more favored to calls, then we would put some more, if the signals flash that there is perceived risk to the downside, then we would potentially put more hedges in place at a more cost-effective basis. And I think the last point is, as a team, we're following the market. Our nose is close to the market. We've been paying close attention to the US market open dynamics. Often we've been, allowing the opening volatility to settle a little bit, to establish some sort of directional exposure where we can, if we can see some early spot strength, we've delayed short call selling, which has proven effective of late. From ETH, just to wrap it up, our preference is to do short call spreads, particularly still monetize that richer volatility premium, but cap any potential losses with upside convexity risk is way more pronounced in ETH, obviously, than Bitcoin. So I think to summarize, that's really it from my side. I appreciate your time, and I'll hand it over to Tally to wrap this up and take any questions.
Absolutely. So we do have a couple of questions from the audience. Just before we jump into that, obviously, if you want to learn more about any of the strategies or solutions that Carlo and Andrea have talked about today, please do contact your RM. In addition to that, you are able to sign up for AMINA Research. You can do so by going to the website, going to the research section, or just asking your RM, and they will be able to get you set up with the emails. We send 2 emails, one weekly crypto market monitor, which is really a wrap up of all top market events. And then the bridge also is distributed, which is more of a deep dive into some of the key concepts of crypto. So your RMs will be glad to help you get set up on those emails. In terms of questions, Carlo, Andrea, your work is not quite yet done. So the first one comes in 2 parts. It is, how are you protecting the portfolio if prices fall further? And given elevated put skew, how do you manage the cost of product protection versus waiting for better pricing?
Sure, thanks. I think maybe this is more of a question for me, but Andrea, feel free to chime in as well. I did cover this a little bit. The first part is the portfolio is mostly defensive well, not mostly, it's a multi-strat approach because we have different requirements for clients, but our view is to be more defensive in tilt. So as I mentioned earlier, to bring down skew, to be more cost effective and manage there's richer volatility premium for paying for protection. We do spread, like put spread collar, where you buy a put option at a certain level and you sell a put option at another level just to reduce the cost. And then you fund that combination instrument by selling a call option, because you're not expecting it to go up, and you're expecting it to go down. You can protect yourself within a certain bandwidth. It's not going to go to zero in the next 2 weeks, so you might as well not protect all the way to zero. You just protect through a bandwidth that you think is going to trend within or drop towards. Yeah, I think that's really it. I think that covers it. I don't know, Andrea, if there's anything you want to add to that.
No, sounds good. Sounds good. I think you've covered it. Yeah.
Fantastic. So second question is, how much discretion do you apply on top of the quant signals?
Good question. We would be unemployed if it was a quant signal strategy only. Look, our team is made of 5 team members. We have portfolio managers, we have research analysts. It's a one seat at the table, a prominent voice at the table, I would say, because the back testing in and out of sample has proven to stand, testament. Maybe I could answer this question another way. We provided another client, prominent client, 27 trade ideas driven by the quant framework. Only one was wrong, and very little wrong. So live data. So it has a strong voice. But of course, discretion applies. We look at sentiment. We look at strong technical support levels. We look at resistance levels. We look at news flow. Obviously, the macro. So all things considered, the quant signal is, a guiding factor, but it's a discretionary approach.
Fantastic. Thank you, Carlo. And finally, machine learning models often overfit and do not work well in live markets. Why are yours different?
Okay, maybe I can take this one.
Yes.
The first thing with our machine learning model is that we're not feeding it. We're feeding it only relevant data. So we're feeding it information from the derivatives market, which in my career I've used to analyze markets and to position directionally using options, and also most of the professional derivative traders look at on a daily basis and use them to assess when to hedge, when to rebalance, how to run their directional risk. More than that, many technical macro traders also use them to make short, medium-term, long-term decisions, because derivatives have an element of sentiment in them because they're forward-looking. You have the expiry time, you have the strike price, put or call, which way are you leaning? So we have a lot of information about, this has to be in a developed derivatives market, which Bitcoin today is and Ethereum is, for example. So we're feeding the model only with relevant data. And then second thing is we're using the in-sample and out-of-sample backtesting and also live performance now for the past 8 months or so that have both confirmed that on information and data which is live and the model doesn't have, they're performing. We recalibrate them and we also use scrutiny. We look at them, we try to think what can go wrong, and then we try to add other layers that are not machine learning, like for example the momentum indicator or the market regime indicator that we have, which is something that is more kind of trend following, and we have other things also that we're planning to add to this analysis. So yeah, that's it.
Fantastic. Thanks, Andrea. That is all of the questions. So all that's left to say is thank you so much to everyone for joining us. Of course, if you would like to learn anything further, please do contact your RM. They'd be glad to put you in touch with Carlo and Andrea. We will send this recording out after the session is finished, and do be on the lookout for the next edition of Crypto Market Monitor Live. Thank you very much, everybody.
Thanks. Bye-bye.
Thank you. Cheers.